Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about changes in our accounting policies and procedures that change retained earnings. We've talked about changes in estimate, changes in principal, and changes in entity, focusing on going in and out of that equity classification with stock that we may own. In our last segment, we started talking about the last of the changes we're going to discuss, and that is what happens to retained earnings if we have made a mistake or an error. And the whole discussion hinged on this one key concept, which was, are they counterbalancing or non-counterbalancing errors? Remember that counterbalancing errors will fix themselves over time. If you leave them alone, eventually the balance sheet accounts will all be right, including retained earnings. And we shared an example of an interest expense, which is the example that you see up here. And we also showed an example of what happens if we get inventory wrong one year, but we get it right the next year, and how it fixes itself. Non-counterbalancing, on the other hand, will never fix itself. And we haven't looked at an example of that yet, but we're getting there. As we did our example last time, we looked at Daglin's error missing interest expense. And we said that if the year 3 books are closed, this counterbalancing error will have fixed itself, because I would have recognized net income that was too high in year 2 because I missed interest expense, and then net income that was too low in year 3 because I recognized that interest expense from year 2 in year 3. So the number would have been too high. Overall, I would have recorded a total interest expense of $2,000. I would have gotten all of that $2,000 into retained earnings. So even though the timing was wrong, retained earnings is right, interest payable is gone, cash really has gone out, the note is all taken care of. So this counterbalancing error will have taken care of itself by the end of year 3. So if year 3 books are closed, no entry will need to be made. If the year 3 books are open, on the other hand, then I can fix it. And if I can fix it, then I do. At least that's FASB's rule, and that's what auditors like to see. Sometimes in practice, if the errors are small enough, they'll allow a counterbalancing error to just kind of fix itself, because it's considered immaterial. It doesn't change the investment of our decision makers, stakeholders, investors, bondholders, etc. So sometimes companies will let it slide, but you're not supposed to. If it's counterbalancing and you find it and it's still open and hasn't counterbalanced, then you're supposed to fix it. So let's take a look. This is our year 3, still open. Again, year 3 closed, no entry needs to be made. So once I decide that I need to make an entry, which was step 1, then step 2 is to figure out what they did. And we have 2 years. So we need to look at what they did in year 2 and what they did in year 3. And in this case, we can figure this out ourselves. We can also go back and look at the actual records and find the journal entries so you can see them. What they did was nothing in year 2 because they didn't record interest expense that they should have recorded. In year 3, they would have paid off the notes payable for $100,000. They would have recorded interest expense for $2,000. And just as a reminder, let's go back and take a look at that equation. $100,000 note, 6% interest, $6,000 a year, $500 a month, 4 months total, December, January, February, March, $2,000 total interest. I recorded all of that on March 31st of year 3, so there's that $2,000. And of course, I'm paying it off after 4 months, so I've got a credit to cash of 102. Don't get mad at me that there's no description. This entry's already been made. I'm not making it again. This is just a note to myself on a scratch paper or in Excel so that I have the information I need to fix the mistake and get ready for the real journal entry. But since it's not a real entry, no description. Once I figured out what has been done, then the next thing I need to do, step number 3, is what I should have done. So in year 2, again, it was $500 a month. So I should have recorded interest expense of $500 and interest payable. In year 3, I would have still gotten rid of my notes payable, and I still would have paid out cash. The difference is I would have recorded interest payable of 500, and I would have recorded only 1,500 as interest expense. So there are our steps 2 and 3, what I did and what I should have done. The next thing I need to figure out are what accounts need to be fixed since my year 3 books are still open. What I'm looking for are accounts that aren't currently right. So let's take a look. I really did pay out 102 in cash, and I showed that. What I did matches what I should have done, so I don't have to worry about it. Same thing with note payable. That's right. The other thing that's right is interest payable. Interest payable should have been opened and then closed, so it should have a 0 balance. I show no balance in interest payable over in what I did, so I don't have to worry about the interest payable either. So all I really need to worry about is the interest expense. I showed $2,000 this year. I should have showed $500 last year and only $1,500 this year. So those are the accounts that need to be fixed. And that crossing out accounts that are right and deciding what needs to be changed, that's step number 4. Step number 5 is deciding, what am I going to do to fix these accounts? Well, let's start with interest expense in year 3. It's at 2,000. I want it to be at 1,500. So to get from debit of 2,000 to a debit of 1,500, I need a credit of $500. Well, that credit of 500 matches up with what I should have done last year. There's that 500. But I can't debit interest expense for 500 back in year 2, because in year 2, I would have closed interest expense into retained earnings. The problem, as we showed back here, is that retained earnings was too high by $500. So what I need to do is I need to credit interest expense for 500 and debit retained earnings for 500. This is to correct for interest expense not recorded in year 2. So if the year 3 books are still open, then I need to make this particular journal entry. Step 7 is to fix our statement of retained earnings, but before we can do that, we have to make sure the auditors didn't find any other mistakes, and unfortunately, they did. So when we come back in our next segment, we're going to talk about this other mistake that Daglin's auditors found and what we need to do to correct for that mistake. We'll see you then. Thanks.